Aaron here from Alpha Education. Today's topic that we're going to cover when it comes to investing is the word diversification. So what is diversification? The word is thrown around a lot when it comes to investing, and it's a really good term to understand the meaning of and how to actually apply it when it comes to investing, because it will help you out a lot when choosing your investments and keeping a really strong portfolio. So the action of diversifying something, or the fact of becoming more diverse, is what encompasses diversification. When we look at diversification, we want to take a macro snapshot of where we deploy our cash in order to help us protect our assets from decreasing at the same time. Where does this actually fit into investing? So let's say that we have $10,000 to invest, and you go to purchase all of your $10,000 worth of securities from just one company, and then that company goes out of business to the point when your investment is now worth $0. So you've essentially lost 100% of your investment. Diversification is the act of taking that money and spreading it across either multiple companies when we're talking about securities or investment options in order to prevent all of your investments returning a negative. And this can be done in an infinite amount of ways. Generally, it's done through different investing in different companies, in different sectors, across different countries, so that things like one sector's performance and also our geographical conditions of that company won't affect all of your investments at the same time. It can also be through a number of different investment options. So you can have things like stocks, so individual stocks of companies, ETFs, the exchange traded funds, which we covered before, commodities, cash, whatever. You get to choose your broad range of diversification, but the main point is having something that's not going to take a negative dive and all of your investments move down. And it ties it back to that saying, don't put all of your eggs into one basket. And especially when it comes to investing, you want to make sure that you've got different amounts of cash and not all of your assets under one separate organization, and then it just moves down when you get a negative turn. Okay, so how do I feel is a good way to diversify? The way that I like to invest is to have a core portfolio. So you have a core amount of products that are considered your core portfolio, and these are things like exchange traded funds, which just track indexes, or it might be commodities like gold, silver, some of the stuff that just trends up over time. It could be real estate if you wanted to in your core portfolio, and then if you wanted to try and take your best bet at investing and going into just one company at a time, just small amounts of money. We call that a core versus satellite approach. You've got the core portfolio of the key things that you just dollar cost average into over time. And then you've got maybe 3 or 4 different, maybe singular companies or different forms of investment that you have only a small amount of money in your portfolio, and you just put money into those. You do your research on them, but they make up all of the highest amount of your portfolio, okay? And that way that you can avoid, if those do take a turn for the worst and turn into the negatives, it's not going to affect your actual core portfolio in itself. Thanks a lot for tuning in, guys, and hopefully things have helped here, and hopefully you can learn to diversify your portfolio even better for years to come.